So Alec wasn't very clear on what he wanted me to speak about this afternoon, so I've made up my own story. And basically what I want to talk about is how to manage money, how to think about managing money. Because I know each and every one of you here is interested in investing and investments, and either manages money or allocates money to a fund manager. And it's quite useful just to, just a couple of pointers on what to think about and what to do. So I think the most crucial thing when you are managing money, investing, is to define what your investment philosophy and investment process will be. And each person will have a unique philosophy and process. The investment philosophy is what you do, what you believe in, what works for you. And as I said, that's different for everyone. There isn't a single correct investment philosophy. But it's very important that for yourself, you work out what works for you. You need to understand your own psychology, your psychological makeup, not when it's a nice Saturday afternoon just before the rugby at the Braai. I mean, that's easy. People can make fairly rational decisions under those circumstances, but you need to know yourself when things are stressful, when the world is throwing darts at you. How do you make decisions? What do you fall back on? That is your investment philosophy, and that's something that you need to think about very clearly. And as I said, for everyone, that's unique. And there's, a lot of people who just try and copy Warren Buffett, but they don't have his psychological makeup, and that ends in tears most of the time. So get to know yourself and work out what your investment philosophy is, and write it down. The same with the process. Once you've defined what you want to do, you need to define how you're going to go about doing this, and that is your investment process. Investing isn't about picking a great stock. That's not what investing is about. It's also not about picking the 10 or 20 best stocks either, because that's virtually impossible. What investing is putting together a portfolio of assets that delivers satisfactory returns over a period of time for you. That is what investing is. And your investment process should define how you manage the risk you take when you invest. Because when you invest, you take risk. Even if you invest in a money market fund, you are taking risk. You're taking some form of risk. And that is the key about the investment process. It is a risk management process. It's not a stock picking process, or what the best asset is, let's decide what that is. It is about managing your risk. And again, this needs to be written down. How many stocks do you buy? How many do you own in your portfolio? How liquid are these? And why? Do you want liquid or illiquidity? What sort of industries do you want to invest in, and why? You need to think about these things. What is your vehicle in which you invest? Is it the open-ended vehicle which can have outflows and inflows like a unit trust, which I happen to manage? That introduces a different set of risks. You need to have liquidity at all times, because clients can phone up and say, I want my money back, and you've got to give it to them right away. If you invest in a closed-end vehicle like a company, like Warren Buffett with Berkshire Hathaway, then you don't have to worry about phone calls from investors. They can just sell their shares in the stock market, and you can just carry on investing. So you need to think about those sort of things, and that's your investment process. And again, I've seen a lot of people try and copy Warren Buffett's investment process, but not in a closed-end vehicle or in a company, and that also leads to tears. And as I said, you need to write these things down. You need to create a checklist, because you make your mistakes when the stress is high, and if you haven't got your checklist, you forget a bunch of things. That's what stress does to one. Okay, so that's in philosophy and process. Key aspect of, before you even start investing or think about investing, that's what you need to think about. I think a second key aspect of investing is you need to pick your fights. I read this story a couple of weeks ago about this young kid in America who, well, he actually wrote the story, and he wanted to become a professional basketball player. He was living in Houston, and he was just too small. The guys were running rings around him. And as luck would have it, in high school, his parents moved to China. And this was in the 60s, a long time ago. And he said he went to basketball practice in China when they moved to China, and all the kids there were tiny, scrawny, because they weren't eating protein and that sort of stuff. In any case, that's what he said. And he was like the big guy around there, and he started running rings around them and got picked for the first team and made captain of the first team, met a nice girl, and his life changed because he got what he called SPS, small pond syndrome. And that's a very powerful thing to have in investing, to be the biggest fish in a small pond. Conversely, you want to fish where the fish are and not where the best fishermen are. Those are very important principles to bear in mind. So pick your fights. You don't have to go up against Warren Buffett. You don't have to go up against the best guys in the world. You can pick a different pond, a different fight. The third thing that I think is very important for everyone in this room to realize is that small investors can and should outperform the index, and the index can and will outperform large funds or fund managers. That's the ranking. Small investors, the index, large fund managers. Why is that? Because of the breadth of assets a small fund or small investor can invest in. You can pick from a lot more things. The opportunities are much more varied and diverse. Large funds are restricted to 10 or 20 or 30 stocks on the stock exchange, on the JSE. They have no choice. They can buy the whole of 200 companies on the stock market and it will make no difference to their performance because their funds are so big, 100 billion, 150 billion. You know, the average market cap on the stock exchange of the bottom 200 stocks is like 2 or 3 billion rand. It doesn't touch sides with the big guys. They cannot outperform the index, and the numbers prove it. The large fund managers and large pools of capital underperform the index. Small pools of capital and individuals outperform the index. That is the hierarchy. So that's good news. That's the good news. So it's the size of the opportunity set that determines this, but it's also the risks that the fund manager is managing in the large investment house. That fund manager is not acting as a fiduciary. He is managing his career risk. He doesn't want to be fired. And he is, managing the marketing of the firm. Remember, asset management businesses are remarkably scalable businesses. They generate fantastic returns as you scale up the size. And what happens in institutions is that fund managers become marketing agents because it's so much more profitable. And they take the eye off the ball, and they're marketing, and they're not managing money. That's institutional imperative. So that's why, as a small investor, individual investor, you have a certain power. You have the power to pick from a diverse, wide range of assets, and that's a very important power to have. Alternatively, if you don't want to exercise that power yourself, you can give your money to manage to a smaller fund manager, because they have the same sort of power. So the fourth thing I'd like to touch on is history. I think one of the least used aspects or applied aspects of investing is studying history. Investors, I think I wrote this down here, history repeats and repeats, and the investment industry as a whole learns nothing and forgets everything. Every cycle gets repeated every time, and that's why there are cycles, because it just gets repeated every time. If you can study history, you can understand markets much better and feel much more comfortable with the gyrations of markets, because history shows that, there is such a thing as mean reversion. When things are bad, they get better, and when things are good, they get worse. And that's basically all the forecasting you need to be a good investor. You don't need any more forecasting than that. When things are bad, they get better, and when things are good, they get worse. If you remember that little piece of history, it'll do very well. The other thing to also always bear in mind is base rates. When you are looking at a situation, an investment proposition, say a turnaround of a company, then you just look at how successful turnarounds have been over time and you'll find statistically that most turnarounds don't turn around. Then you will avoid that investment. Stay away from it. That is what it means to study the base rates. You pick a class of occurrences like the one you are studying, and you see what was the average outcome for those sort of things. And that also helps to steer you away from certain investments and towards other investments. So history is very important. So how do stocks actually get cheap? There's another thing to really think about is, when you make an investment, buy a stock, you need to think to yourself, why am I so lucky to be afforded this wonderful investment opportunity? How does this work? Because the market is a very efficient weighing mechanism. It takes a whole bunch of diverse opinions. Everybody that invests in the market, that buys and sells shares, takes a whole bunch of diverse opinions, weighs them up with an independent aggregation mechanism, the stock market itself, the auction method, and comes up with a value of a business. And that value is, over time, fairly accurate. And for a stock to be not priced efficiently, you need either a diversity breakdown, diverse views that conform and are not diverse, or you need the aggregation mechanism, the market itself, to not be functional. That's when stocks get cheap. So you need to be on the lookout for those sort of things. The classic example of an efficient market is at the farmer's market, where the famous example where they have a cow there, and they ask people to guess the weight of the cow. And everybody who comes to the market over the course of the week guesses the weight of the cow, writes it on a slip of paper, puts it in a box, and at the end of the week, the farmer then awards the cow to the person who got the closest. But the most accurate estimate of the weight of that cow was obtained not by any one individual, but by adding up everybody's numbers and dividing it by the number of entries. The average guess was the most accurate. That's a bunch of diverse opinions, efficiently aggregated. Came up with the right answer, spot on. And these people weren't farmers, they didn't really know a cow, but they got the weight, the collective got the weight right. And that's the stock market. The stock market gets it right more often than not. So when you are looking at an investment opportunity, you need to think to yourself, why am I being offered this? Why do I think it's cheap? And it either has to be because there's a diversity breakdown or the aggregation mechanism is not working. So in what sort of situations do these things apply? Things like forced selling. When you have an investor who has bought an asset on leverage, using leverage, and the bank says, no, I want my money back, and that investor has to sell the asset. That's the aggregation mechanism breaking down, because there's a forced seller taking place here. There's a forced selling taking place here. Spin-offs is another classic example of a diversity breakdown. When a company like Naspers spins off a company like MultiChoice to its shareholders, Naspers shareholders sit in New York and London, they're big institutions in South Africa, and they get this small company called MultiChoice, which has got nothing to do with Tencent or any of Naspers' other businesses. It's a satellite TV business, which nobody likes in any case. They sell it. They don't ask questions, they just sell it. There isn't a diversity of opinion determining the price. The people who receive the spin-off just sells it. So that's another place to look for cheap assets and spin-offs. The classic one this year was Thungela, or last year it was Thungela, the coal business, spun out of Anglos. Anglos didn't want coal anymore, spun it out. People said, I don't want to invest in coal. So everybody just sold it. And look where it is now. I think it was spun off for 25 Rand. Today it's 350 Rand. And also when there's a disaster, some sort of market disaster, diversity breaks down. People all have the same opinion and they're all selling or buying, whatever the case may be. Diversity breaks down and then you get mispricings happening. So understanding how stocks get cheap, how and why stocks cheap is very important in an investment process. A couple of things you can also eliminate to make your life easier, to simplify your life when you're investing. Stop doing macro forecasting. Just stop it. Don't worry about where interest rates are going and what's the rand going to do. And is the economy growing by 2% or 3%? It doesn't matter. Those things just don't matter. If you want to do macro forecasting and invest on the basis of your macro forecast, you've got to get two things right. Number one, you've got to forecast that variable correctly, and that's almost impossible. Nobody can do it consistently. All these economist surveys show you that. Every year there's a different winner of the best economist. So you have to get your forecast right. And the second thing that has to happen is you need to get right what happens in the market if your forecast is right. So if your forecast is GDP is going to grow by 3% next year, what does that do to the market? And that's even harder to get right. It's much easier to take the annual report of a company, look at its cash flows, understand its business dynamics, and make up your mind whether the stock is cheap or not. Because all you know about interest is they're going to go up and they're going to go down. If you hold the stock for long enough, during your holding period, interest rates will be high and they'll be low. The rand will be weak and it'll be strong. Oil price will be high and it'll be low. You just don't know when, but all those things will happen. So forget about macro forecasting, simplify your life. So that rules out any questions to me about where's the rand going to go. It doesn't matter. Market timing. Don't try and time the market. If you find a cheap asset, buy it. If you think an asset you own is expensive, sell it. Don't try and time it, because you're wasting your time. It's almost impossible. The market's smart. It's much smarter than me or you. Relative comparisons. That's an important one. Don't think in relative terms. Think in absolute terms. The classic example, there's two examples, is people will walk blocks to find a cheaper can of beans. If the can of beans costs 7 rand less 3 blocks down the road, you will walk those 3 blocks to save the 7 rand. Generally, I mean, that's human psychology. But if a car costs 7 rand less, you wouldn't care. But it's still 7 rand. You're still saving 7 rand. And also, if a liter of milk costs twice as much as 1 liter of milk, that's right, but it doesn't say anything about the value of milk. Is milk worth whatever price you're paying? So relative comparisons can be misleading, and it's best to stick to absolute measurements. So also don't measure my performance relative to anybody else, please. And the most important thing, when it comes to investing, this is my last point. The most important thing, avoid a permanent loss of capital. That's the most important thing you can do. Avoid a permanent loss of capital. So that's a nice thing to say. That's motherhood and apple pie, but what does that actually mean? How do you do that? Well, let's start with how do you lose money on a permanent, how do you make a permanent loss? I think there's 2 ways that happens. The first way is either you buy what I call a growth bomb, or you buy a value trap, or you buy an outright fraud. All 3 of those will lose you money and you won't get it back again. A growth bomb is something like Naspers 18 months ago. When the expectations built into the price of a stock is so high that it can never meet those expectations, at some point it disappoints and the share price drops a lot and you struggle to make that money back. A value trap is a stock that looks very cheap, but it stays very cheap forever because it's a bad business or is run by bad management or a combination of those 2 things. Or an outright fraud, something like Steinhoff or Tongaat or something like that. There you also will suffer a permanent loss of capital. So that's one way, you buy one of those type of assets. The other way is if you sell your investment during a market turndown at the bottom of the market, when you are suffering from severe psychological stresses and you're not looking at your investment checklist that you set up previously, as we discussed, and you can't help yourself, you have to sell this. And lo and behold, 2-3 years later, the stock is at new highs, but you've locked in your losses. Those are 2 ways. How do you avoid that then? How do you avoid a permanent loss of capital? For me, it's quite simple. I try to invest predominantly in businesses that have strong balance sheets, that are, in other words, not highly leveraged, and that generate good cash flows, that don't need injections of capital the whole time. That's always a clue if a company needs to borrow more money every year or needs to raise more equity every year. strong balance sheet, good generator of capital. Those companies are generally not value traps. They're generally not frauds. Frauds and value traps and even growth bombs are characterized by a lack of cash. There's not a lot of cash behind the numbers. And also, if you own an asset and there's a market panic, a sell-off like we had in COVID in 2020 and many, many sell-offs previous to that, if you own a business that generates good cash flow, that has a solid balance sheet, that business has many ways, many levers it can pull to make money for you as a shareholder. Those sell-offs create opportunities for strong businesses. They can make acquisitions, they can start new businesses, they can do all sorts of things because they are inherently strong, regardless of what their share price is doing at that point in time. So if you own a business like that and there's a market sell-off, sit on your hands, don't do anything. That is another way to avoid a permanent loss of capital. Because I don't know what the average annual return on the JSE has been over the past 40 years, but I think it's high, it's mid-double digits. It's good returns. But there have been major sell-offs during that period. And if you owned good stocks during that time, you didn't need to worry about it when the market is selling off. So those are just a few sort of tips and practices that you can apply in the management of your own money, or when you think about, if you're thinking about giving it to somebody else to manage, those are things to think about as well. So I think I've overstepped my time, but thank you very much.